Hey guys, Joshua here. So in today's video, we're going to go over the 6 best growth ETFs that you should be investing in if you want to see exponential growth within your portfolio. So let's not waste any more time. We're going to hop directly into number 6 on the list, which is VBK. This is Vanguard's small cap growth ETF. VBK seeks to track the performance of the crisp US small cap growth index, which measures the investment return of small cap growth stocks in the US. So to kind of give you some context here of what a small cap stock is so that you actually know what you're investing into, it's a stock of a company that has a market cap between $300 million and $2 billion. Generally speaking, small cap stocks have outperformed large cap stocks, and that's because they're smaller companies that have a lot more upside potential to grow. But that does come with a price. Small cap stocks are known for their volatility and are just generally riskier investments altogether because the companies are so small, they have a lot more potential to fail, which of course would not be good for investment gains. And that's why Vanguard rates this ETF as a 5 on their risk scale, where 1 is the least risky and 5 is the most risky. VBK holds a total of 695 stocks, with its largest holdings including names that you likely won't recognize, such as Charles River Laboratories, PerkinElmer, Biotechna, and others. Okay, so let's talk about the performance of this ETF. So VBK has given a 17.82% return over the last 5 years. This means that if you would have invested $10,000 into this ETF 5 years ago, your investment would have grown to nearly $23,000. In terms of how much it costs to own this ETF, it's pretty cheap. VBK has an expense ratio of 0.07%, which means for every $10,000 that you invest, you'll only pay $7 per year on it. VBK is an incredible growth ETF that is definitely worth considering. That being said, it is sitting at number 6 on the list, which means that we have 5 others to look at, and all of these are going to be fantastic. So at number 5, we have a very well-known ETF by Mama Kathy herself, aka Kathy Wood, and that is the ARK ETF. It would be almost insulting to not include ARK on this list, considering its main objective is to invest in companies that will provide long-term capital growth. You can think of companies like Tesla, Coinbase, and Zoom. All of these companies are shifting the market and they're innovating in new ways. Tesla with their electric cars, Coinbase with making cryptocurrency accessible to the general public, and Zoom, of course, with changing the way that teams meet and communicate. Now, unlike most of the ETFs on this list, ARK invests in a very small number of stocks, typically between 35 and 50 stocks at any given time. ARK's top holdings include Tesla, Teladoc, Roku, Coinbase, and many other companies that you are likely familiar with. When it comes to performance, ARK has performed extremely well, especially considering that it's a very new ETF. It was founded in 2014 and since then has given an average 5-year return of 48.65%. This means that if you would have invested $10,000 into ARK 5 years ago, your $10,000 investment would have grown to, wait for it, a whopping $58,245 in just 5 years. Now, this insane growth does come with a price, and that price is in the expense ratio, which is much higher than any other ETF on this list, coming in at 0.75%, almost 1%. A 0.75% expense ratio means that you'll be paying $75 per year on $10,000 invested. I know that doesn't sound like a lot, but that money adds up really quickly, especially if your portfolio is larger than just $10,000. The reason for this high expense ratio is that this fund is actually actively managed. Therefore, the expense ratio is a little bit higher to pay for those management fees. So if you compare this to the $4 per year that you'd be paying on pretty much most low-cost ETFs, that $75 starts to sound like a lot. In terms of risk, ARK is probably the most risky ETF on this list, coming in at a 5 on our risk scale. However, because they're not afraid to take these types of risk, it also means that their returns are much higher than any other ETF on this list, but with high returns also comes high fees and high risk. At the end of the day, it's going to be up to you to decide if ARK is going to be a good investment to add to your portfolio or if it's just too risky for you. Okay, coming in at number 4, we have IWP, or the iShares Russell Mid-Cap Growth ETF. The primary goal of this ETF is to track the performance of the Russell Mid-Cap Growth Index, which is an index full of mid-cap companies. So earlier we talked about small cap companies, which have a market cap of between $300 million and $2 billion. Now, mid-cap companies have market caps between $2 billion and $10 billion. Mid-cap companies have already proven that they have a working business model because they were able to grow large enough to be considered a mid-cap company. This means that they tend to be less risky than, say, a small cap stock, which are arguably the most risky stock investments outside of like a penny stock. However, because this ETF only holds stocks, it's still relatively risky, therefore sits at a 4 on the risk scale. IWP currently holds 386 mid-cap stocks with top holdings in DocuSign, Roku, Roku, Chipotle, Pinterest, and others. This ETF has seen some impressive returns over the past 5 years, coming in at a 20.26% average. $10,000 invested into this ETF 5 years ago would be worth about $24,000 today. Now, the expense ratio on this ETF isn't as high as, say, ARK, but it's also not the lowest expense ratio on this list, coming in at 0.23%, which means on $10,000 invested, you'd be paying about $23 per year in fees. All right, so we're a little bit over halfway through the list, and things are going to start ramping up a little bit here. Coming in at number 3, we have SPYG. Now, you may recognize this ETF a little bit, and that's because it's a variation of the most popular ETF in the world, the SPY. The difference between the SPY ETF and SPYG is that SPYG only invests in growth companies, whereas the SPY invests in all 500 stocks that make up the S&P 500. On the contrary, SPYG only holds half the amount of stocks at 240, with top holdings in Apple, Microsoft, and some other names that you'll definitely recognize. Over the last 5 years, this ETF has given a 21.71% return, which means $10,000 invested 5 years ago would be worth over $26,000 today. This ETF falls in at a 4 on the risk scale, and understandably so, because it only holds 239 stocks, plus its top 10 holdings make up almost 50% of its entire portfolio. The expense ratio on this ETF is only 0.04%, which means you're only paying $4 per year on $10,000 invested. I mean, you really cannot go wrong with this ETF. You got the high returns, the low expense ratio. What else could an investor ask for? Well, how about number 2 on the list, QQQ, or Triple Qs, which has even better returns and a very fair expense ratio. Triple Qs is one of the most established and actively traded ETFs in the world. It tracks the performance of the NASDAQ 100 index, which is the world's leading large cap growth index. By investing in this ETF, you are giving your portfolio exposure to the largest companies listed on the NASDAQ exchange. Triple Qs currently holds 103 stocks with top holdings in Apple, Microsoft, Amazon, Google, and many other household names. Now, one of the reasons for this ETF's massive success is its impressive returns and its reasonable expense ratio. Triple Qs has an average 5-year return of a whopping 27.98%, which means that $10,000 invested over a 5-year period would turn into $34,400. A noticeably larger return than other ETFs on this list, with the exception of ARK, but it doesn't have as big of an expense ratio as ARK either. Triple Q's expense ratio is 0.20%, which means it costs $20 per year to own this ETF on $10,000 invested. However, this ETF is still very risky, and that's because it is investing in a really small number of stocks, especially when compared to other ETFs like VTI, which holds closer to 4,000 stocks compared to Triple Q's 100 stocks. However, with great risk comes great rewards. This is why ARK, for example, has the highest investment returns of all the ETFs on this list, but that's also why it's the riskiest ETF on this list as well. Now, although Triple Q's offers some really impressive returns, it's also notorious for its volatility. During a bull market, when the stock market is seeing massive gains, Triple Q's is your best friend. It's the ETF that everybody wants in their portfolio, but during seasons of downturn, it can cause you to lose sleep at night. For that reason, I'm giving Triple Q's a 5 on the risk scale because this ETF is very risky. Still, an incredible ETF with really high returns. I personally do hold some Triple Q's in my portfolio, and honestly, if you're investing for the long term anyways, then the volatility really shouldn't have too much of an effect on you at all. And now for the grand finale, the number 1 growth ETF to invest in on this list is VUG, which is Vanguard's growth ETF. This ETF seeks to track the performance of the CRSP US Large Cap Growth Index. So very similar to number 6 on this list, which tracked the CRSP US Small Cap Growth Index. This ETF tracks the Large Cap Growth Index. VUG currently holds 287 stocks, with its largest holdings including companies like Apple, Microsoft, Google, Amazon, and others. Over the last 5 years, VUG has given an average return of 22.7%, which means if you invested $10,000 into this ETF 5 years ago, your investment would have grown to nearly $28,000. Additionally, VUG has an absurdly low expense ratio, coming in at only 0.04%, which is only $4 per year on $10,000 invested. For an ETF that has an average 5-year return of 22.7% and it still only charges a 0.04% expense ratio, that's pretty impressive. Plus, the risk level on this ETF is slightly lower than the other highest returning ETFs on this list, coming in at a 4 on the risk scale. Overall, you really cannot go wrong with adding any of these ETFs to your portfolio. The biggest thing that you should keep in mind when adding stocks and ETFs to your portfolio is not to have too much overlap. So, for example, let's say that you wanted to invest in VOO, which is a popular S&P 500 ETF from Vanguard, but you also wanted to invest in SPY, which is another popular popular S&P 500 ETF. Well, that wouldn't make sense to add both of those ETFs to your portfolio. Yes, the ticker symbols on both of these ETFs are different, but that doesn't mean that the underlying investment is different as well. They're both investing in all 500 stocks that make up the S&P 500. And so in this situation, you would just pick one. You would either choose VOO or you would choose SPY, because they're both investing in the same exact thing. And you would just pick one ETF and go with that for your portfolio. Typically, you would go with the ETF that has the smaller expense ratio, which is in this case VOO. Now, another really important topic that I want to discuss with you is the difference between portfolio tilt and portfolio overlap, okay? Because there is a difference, and I personally have never heard any other finance YouTuber talk about this, but it's really important that you understand the difference. Portfolio tilt is when you intentionally give more weight to a specific sector or investment strategy in your portfolio. For example, you might be investing in VTI, which is Vanguard's total stock market ETF, and this ETF does a really good job of giving your portfolio super broad exposure over the entire US stock market. However, let's say that you wanted to tilt your portfolio perhaps to the tech sector, right? You wanted to invest more of your money into the tech sector than you are to the broad market. In this case, you would want to go and add another ETF to your portfolio, preferably one that is investing heavily in stocks in the tech sector, and you would add that investment to your portfolio alongside your VTI investment. And so yes, there will be some overlap in your portfolio, but this is all intentional. You are intentionally tilting your portfolio to target a certain market sector or investing strategy. Hey, if you made it this far into the video and you found some value out of it, go ahead and drop a like down below. Also, if you like content like this and you want to see more of it, please subscribe to my channel. I would love your support so much. It means the world to me. And as always, I will see you again very soon. Take care.